Raamdeo, good morning. Good to have you with us. And what a fantastic quarter. Highest ever net profit that you've seen this time around. Take us through some of the highlights of the quarter gone by and what really some of the driving factors were.
Okay, good morning, everybody. It was one of the most exciting quarter as well as a year in 2021. And actually, if you look at the detailed declaration, it's about 1,600 crores profit against literally no profit last year, or actually loss. A profit of about 200 crores. So this is a bumper year, and it is aided by the mark to market in the portfolios, and of course the operating performance has also been quite staggering. So actually, this company is made up of four businesses. First is the broking, second is asset management, third is housing finance, and fourth is the portfolio management or treasury. And treasury is very important part of the business. So broking has had a stellar year, and literally the profits doubled in the whole year. And we had some 700,000-800,000 customers being added in the current year. So the momentum in the broking side is fully on. And you might have seen other competitors' results also, which were fabulous. So broking is firing all cylinders. Asset management, first 2-3 quarters had a little challenging time because the markets were down. So average AUM on which we get our commission was also low. And now in the Q4, it has come back fully. Asset management business did very well for the second half, but first half was a little challenging because of lower AUM. Third business is your housing finance, which has been suffering for the last 3 years, I would say. And probably this year, you couldn't have had more challenging year than 2021. And here, the company has done well. It has earned about 60-65 crores of profit. We hope that we have bottomed out. But the second wave of COVID, if it was not for second wave of COVID, I think I would have declared that we're out of the woods and will grow and build finally on our this last piece of the business. So that has been a very happy coincidence. And fourth is our treasury, which is all equity, and that has done exceedingly well. And so about 700 crores of treasury gains and about 600 crores of operating profit. That makes it about 1,500 crores of net profit for 200 crores of last year.
Okay. You mentioned, of course, the impact of the COVID second wave. Raamdeo, give us a sense of the outlook going forward as well.
Yeah, so again, we go business by business. Since the second lockdown is not very damaging in terms of, it's not a complete lockdown. So I would say 1/3 lockdown, if you want to put some kind of number. So obviously businesses will not be in such a bad shape. So broking is still very steady and doing well. And it is also held by global markets. And the US markets, you might have seen the results and all. They are completely, because they are recovering. And hence, what they do has impact on emerging markets because they source a lot of stuff from here. So clearly, India will also be on the revival path, thanks to other developed markets doing well. So I don't think the markets will be, will not see debacle like last year, in this year, 21-22. So I would expect asset management business also to do well, much better than last year because my average AUM will be much higher. Third, HFC, as I said, subject to this second wave, my team is ready, books are clean, fully, and we have paid our tuition fee fully. So we think that we will do well there, and portfolio is dependent on how the markets do. So I think we are not going to have such a blowout year like 2021, but 21-22 should be more of a consolidation. In fact, the portfolio gains may not be as big as this year, but my operating profit should be much better because last year, actually two businesses did well, broking and asset management. This year, housing finance, asset management, and private equity, all three are likely to do well. So my operating performance will be better, but portfolio performance obviously cannot be as big.
Raamdeo, hi there. Good morning. Avan as well joining in. Just wanted to understand how you're looking at the texture of the entire market. While today may be a bit of an aberration, despite what's been going on with the escalating COVID cases in the country, the markets have been seeing quite a bit of exuberance. To think just yesterday we were at 15,000. What do you think is fueling this optimism in the equity markets? And share with us how you expect the rest of the year to really pan out. What are you advising?
So it's a very challenging year because this COVID-2 second wave, then probably even third wave. And so there are a lot of things which are happening on the ground, which are keeping the consumers in the house or mobility restricted. So it is extremely difficult to predict what is going to be the business outcome in specific business. And one good thing for the global economy is that US, UK, China, I mean, these countries have come out of COVID. I mean, at least they're declaring that they have broadly come out of the COVID, and since they have a massive pool of savings with them, they are going better in terms of consumption. All the pent-up demand is coming up. You might have seen today Facebook and Google and all those results. They are up by 50, 60, 70%. It's unprecedented. So that particular kind of demand, consumer getting unleashed, is, I mean, since they are import-dependent economy, the imports will come from China, India, and the rest of the world. So I would think that there will be business momentum led by America and China, because what you import from China, if China doesn't have, China also has to import. So I think there will be aggregate demand in the global economy will be high, and that will determine a lot of businesses what they do. And it will be extremely selective. It is very tough to figure out who is benefited, who is getting hurt. So I think it's very unusual kind of a situation. I mean, some pockets are so good that you cannot believe they never had it so good. And some pockets are so bad that they never anticipated this is going to happen. So it's a mixed kind of a scene.
And do you believe that the financials will remain fairly vulnerable to this, and that when one looks at the financial basket, that you would now only stick to some of the large cap top tier names within the space, the ICICI banks and HDFC banks of the world? What's the outlook?
Stick. I mean, I can tell you only what I do, what I'll do, what is going on in my mind. You know, the ones which have been able to weather last 12 months well, I mean, of course, everybody is impacted. Whether bad, ugly, small, big, everybody is impacted. But the one who is able to weather this last 12 months well, they are the ones going to get on. Right now, this is not the time to speculate on what is going to be the outcome of COVID second wave or third wave or fourth wave, because this beast is completely unpredictable. I mean, the risk is whatever one is pricing. I can tell you, I mean, people don't know what are the risks ahead, and risk is the one which you don't know. So I think we are in a slightly uncharted environment. This problem is not contained. So I would be sticking to a little safer kind of counters rather than being speculative. Because the ones which are small or not so good, they have a speculative gains possible if the economy settles down. But to believe that economy settle down in next 12 to 24 months, that could be premature right now.
Okay, fair enough. In terms of participation, Raamdeo, how do you see the breakup? You know, there's been, of course, talk or conversation about how retail participation has picked up as well, you know, particularly with everyone still being at home and sort of trying to get engaged in the markets. But going forward, what do you feel is going to be the mix or the kind of pace of growth that we're seeing in terms of participation from different categories?
Yeah, so there are certain businesses which are resilient and actually done well in the last 12 months. I think they will continue doing well. So like financial services, they're broking and all. What we were fortunate to have done well in last 12 months. So we hope that we'll do well. And still the momentum is on. Yesterday, you might have seen record volume of almost 100 trillion rupees got traded yesterday on Thursday on expiry. So that's the kind of record. They are still hitting new highs. So I think the business correlation now, I think new opportunities are coming up in pharmaceuticals by the vaccine suppliers, all kinds of commodities that is on fire because consumption boom is there. So underlying commodities have to be in short supply or at least got squeezed. Capacity has not been added. So I think they are doing well. So I think recovery-led, global recovery-led, even the tech spend is booming in US. You might have seen the deal wins all over. And I spoke to some people who said even in April, May, June, they are going to see very strong deal pipeline. So I think that is segment, software segment is building up well. Pharma, software, selective financials. Because fortunately, what has happened is that after writing off all the bad loans in last 1 year, there was no further lending to be stressed. So I think it is a I would say, a portfolio which has been corrected for credit cost. I think that in the second wave, with the low interest rate, massive liquidity, partial lockdown, I think credit costs will spike, but will not as bad as that of last year. And hence the earnings recovery, even in the financials in India, will also be pretty strong.
Okay, great. Any risk that you see, I mean, separately, not necessarily from a brokerage business point of view, but from the financial section point of view, in terms of, this particular round of restrictions and lockdowns leading to sensitivity or vulnerability for the sector in terms of payments, in terms of NPAs going forward? Is that a risk? Is that a real risk according to you?
See, in lending business, you are leveraged, right? 8 to 10 times of the equity. So this kind of risk must be giving nightmares to the CEOs, because which way it will turn, how deep it can come, because it's a very large country of 1.35, 1.37 billion people. And we are still talking about just about 1.2% of the population will be tested positive. So, tested altogether. So I think the healthcare capacity and healthcare facilities is very limited, and I mean we can have some. I don't want to. The risk could be unnerving in terms of what can happen if things really go out of hand. So there is a lot of fear, but generally with so much of alertness, things don't go out of hand. So I would still be cautious on COVID side, but you never know from where trouble will come. The risk is, the very definition of risk is you don't know what is the shape of the risk. So so much of liquidity, so much of so low interest, booming commodity prices, something might break down. I don't know what that would be.
Yes, that will certainly be closely watched out for. But Raamdeo, the kind of commentary that we're getting within the auto space is that the high raw material prices, the high input prices are definitely impacting earnings. That was what was said by Maruti as well as Bajaj Auto. And the expectation is that this is going to remain a concern for some time to come as well, despite what they may have delivered in their quarterly numbers. How have you read into this commentary, and do you believe it's going to be a challenge for some time for autos?
Yes, clearly, if the commodity prices keep surging, see, once it surges and stays there, then it is much easier to pass on, because typically, commodity prices within an auto would be about 20-25%. if you go by the kg, a ton of the Maruti car would be that can see even in a 5 lakh rupee car, if 1 lakh rupee is the commodity price, even if it spikes by 20%, so that's about 5-6% to the sales price. So that of course, once it can be passed on, it is stressful, some margin sacrifice will be there. But again, on 20% increase, I don't see again 20% increase in the raw material prices. So yes, it will be smaller, so it can be passed on. But I think auto sector has gone through some crazy times in the sense that transition from BS4 to 6 and on top of it 28% GST, and now there is a slowdown. So I think it's one of the very important manufacturing base. I believe almost 45 to 50% of manufacturing is from it. So my sense is that it is little this year will not be a great year for autos broadly.
Okay, fair enough. And what about metals? There have been some clear wealth creators for investors. Yesterday there was the news that China will be removing that rebate of 13% VAT on steel exports from the 1st of May. We've seen this sector seen pretty phenomenal gains across the board. Do you believe that it's time for the commodity-linked space to shine in trade?
Right now it's shining like never before. So I think there is a shortage of all kinds of just one sec.
Okay, speaking of metals, just let's quickly check in as to what metals are up to in today's trading session. Remember, yesterday it was a sea of green across the board. Today you're seeing the likes of SAIL continue to power through. Tata Steel, BSL 7%. Moil is looking rather active. Of course, we're not comparing what we saw yesterday because the market mood in general is rather somber. NMDC, Tata Steel, just checking in on some of those names around there, and they're all rather active in today's trading session as well. And you said shining like never before, right?
So yeah, I mean, I think the capacity addition has not happened, and the bumper demand for all kinds of durables coming back simultaneously. And I think the low interest rate environment is also giving chance, because most of the metals are listed in one exchange. So there is a massive speculation in the commodities, and demand is strong. So the price action, I mean, it's all across. I mean, whether you look at the corn, whether you look at the logs, whether you look at plastics, steels, and copper, whatever is traded anywhere, it is on fire. So it is to do with the lot of liquidity sloshing around, and demand being very strong after the COVID is subsiding in many parts of the world.
Raamdeo, on the back of that, we've all been talking about the cyclical theme versus defensives and the kind of return possibility on cyclicals, particularly at a time like this, and whether one should make the most of it. Would you agree? Would you be beefing up on that? Would you say still stick to a fair amount of defenses, given that the next few months are uncertain? How would you be going about it?
It's very challenging, I can tell you this. Managing large money, shifting from one side to other is very challenging, but we'll do whatever we can do with our understanding of things. But definitely one cannot sit absolutely not taking notice of the opportunities here.
Okay. Infra, is that a pocket that you're still confident on, given the fact that we are seeing a spending push coming in on that front? Is that again a segment that's perhaps a bit stalled in the interim? Or would you say, steel aside, cement, infra, even a real estate to an extent will continue to thrive?
Yeah, I mean, right now, India itself, I mean, sitting here, it looks that things are green, I mean, on the ground level. But what is happening in the other markets like China and the US, and so I think everything is dollar priced. I mean, one way or other, all the commodities are dollar priced. So if there is a boom in China, boom in US, obviously it will boom here. So that's what is really happening, and the difficult part is to really fathom what is it a super cycle? Is it a temporary blip? Vertically it has gone up, and vertically it can fall. So those, I mean, in commodity, those dangers are there. If there is a demand collapse for some reason, any part of the world, right now it is taken for granted that demand will surge. Right now it looks that till global monetary system starts tightening, I think we have a good one, at least 1 year. more for it to kind of surge. So I would think that the current trend is likely to strengthen, and there is an opportunity.
You know, market men who we speak to across the board keep alluding to the fact that new technology, digitize or die, that sort of a theme is here to stay for the long haul, and those who don't adapt and mold their business model, particularly even within the financial services place, are likely to be left behind. How are you looking at capitalizing on this new tech as well as strong digitization play across the spectrum? Will it be via unlisted players? Are you looking at traditional IT plays, even those within the lending space in the banking sector?
Yeah, I mean, see, digitization is now here to stay, and it's going to become more and more important part of life. I mean, if you look back 15, 20 years, I mean, there were no internet. Today, without internet, you cannot do anything. So this is how the technology keeps, every day it keeps becoming more and more important. I mean, today, earlier tech used to be only support function. Today, if you don't have tech, howsoever good in your profession, I don't think you are going to make it. So importance of tech is increasing slowly, and now with this pandemic, it has even accelerated. So one has to look for the businesses, like infrastructure business is very suited for online kind of fulfillment of end-to-end. So and very, I mean, the capacity of financial system can be literally unlimited. So if you are selling some physical goods, your capacity is limited to whatever is available. Say you are selling cement, even by online, you can only sell that as much as you can produce. But in case of financial services or a lot of services, the capacity is literally unlimited. And as the volume goes up, your cost per unit goes down. So like Facebook or Microsoft or these things. So this digital economy is quite mesmerizing, and we have just about started. So I think now all these digital companies slowly in India also will get listed. We are a little delayed here, but we are definitely going to see many companies coming in which are pure digital, 50% digital, 70% digital as we go along into the future. So I think our understanding, biggest thing is that particularly people like us who are not children of digital economy, we have to improve our understanding of this particular way of thinking, because the digital economy, digital companies are not built like EPS and PE. I mean, they are very different way of building up businesses. Eventually, they make money, a lot of free cash flow, and that's what you value. But to start with, it could be very different way. And by the time you realize it's a good business, valuations are crazy. So it is somewhat different. It will be difficult, but we will try to learn the game, and let's see whether we can really come on top of it.
Okay, it certainly is mesmerizing, and adapting to digitization and tech is perhaps the only way forward, especially in these challenging times. Raamdeo, pleasure as always connecting with you. Thank you so much for joining in and sharing with us your outlook on the markets.